I'd like to welcome you to our Commerce Lexington Policy Luncheon Series presented by Kentucky American Water. Also, want to thank you all for joining us here to listen to our special guest, Congressman Andy Barr. And before we turn this over to the Congressman, I would like to introduce a few of our guests here with us. Kevin Courtois. Kevin is with the U.S. Chamber of Commerce. He's a partner of ours, and we'll hold our applause till the end. A partner of ours, and we enjoy working with you and your team, Maggie and folks. He's out of the Chicago office. Our federal officials, we have Robin Taylor, State Director, Senator Mitch McConnell. And Robin, as I said earlier, please give the Senator our very best wishes for a quick recovery. Stephanie Nelson, Central Kentucky Field Rep for Senator McConnell's office. Stephanie, we love you to death. Thank you for all you do for us. Tatum Dale. Tatum, where are you? There you are. Tatum is the District Director for Congressman Barr. She's exceptional, and we enjoy working with you, Tatum. Mackenzie Todd, Deputy District Director, Congressman Andy Barr. Nice to see you. Thank you for joining us. And Caleb Hazlitt, Constituent Services in Congressman Andy Barr's office. Where are you at? They're glad to have you as well. At this point, I'd like to take this opportunity to thank our event sponsors. The sponsors are listed in the program there at your table. Our sponsor support enables Commerce Lexington to keep our members informed about important issues. Now I'd like to invite Shelley Porter, Director of Engineering for Kentucky American Water, to the podium to make some presenting sponsor remarks. Shelley.
Good afternoon, everyone. On behalf of our team at Kentucky American Water and our President, Catherine Nash, who's also with us today, we want to welcome everyone to today's luncheon and especially extend a warm welcome to Congressman Andy Barr. My name is Shelley Porter. I'm the Director of Engineering at Kentucky American Water, and I've been serving in that role for the past 2 years, where I relocated to Lexington, Kentucky from West Virginia American Water, where I was born in Huntington, West Virginia. My roots run deep in eastern Kentucky. When visiting my grandfather, there was one plaque on his wall that made us know he was the most important man in the world, and that was his commission for the Kentucky Colonel. So we always knew that's what made him so important. And I appreciate to extend that legacy of service to our communities through my involvement with the Bluegrass chapter of the American Red Cross, serving as the committee chair for the Diversity and Inclusion and Equity Committee, and also with our disaster response, especially to events such as the flooding in eastern Kentucky. I also have appreciated joining the Junior League of Lexington and the wonderful ladies that put thousands of hours of community service to support organizations across our central Kentucky region. They do that through fundraising with the horse show and our holiday market and many hours in community partnerships across our community. My engineering team and I take great pride in the work that we do in our company surface territory, which extends across 14 counties and is over 2,300 miles of main, including our water and wastewater plants. To put that into perspective, if we would lay our pipe end to end, that would go from Florida to Seattle, Washington. And we need to keep that system watertight to make sure we offer quality service to all of our customers in our region. We know how important our infrastructure is to the community and for economic development. And that's why we look for innovative ways to support the communities and also look for solutions with our federal regulators and our government officials and community partners to look for water and wastewater solutions to allow our communities to grow. At American Water, we have significantly expanded our investment. We have put over $40 million in 2022 and over $50 million expected this year to upgrade our infrastructure. We know that these projects across our community can be disruptive at times, but please bear with us as those investments that my grandfather's generation put in place, it's now our turn to do the same. So bear with us as we make these upgrades. And Congressman Barr, thanks again for spending time with us today, and we look forward to your comments.
spoken like a true engineer. I like that. And a great community advocate. Thank you very much, Shelley. She said she was nervous. I said, well, it didn't show. You did a great job. Thank you. And to Kentucky American Water, Catherine, I know you've got some board members here and you got some of your incredible staff. Thank you for your investment in this series and in our region overall. So I'm going to do a little bit longer version of the introduction for our congressman. And I'm going to do it with a very specific idea in mind. We have, as our congressman, someone who has been linked in to some of the most major, significant issues that we deal with as a country and right here in central Kentucky. And should we not forget of how fortunate we are to have him plugged into those roles and his leadership in each of those, it would be shame on us. So I just want to hit on some of the things, cover some of the things that he does for us. He has served as the U.S. representative for the 6th Congressional District since 2013. Congressman Barr is a senior member of the House Financial Services Committee, where he serves as the chairman of the influential Financial Institutions and Monetary Policy Subcommittee. This subcommittee has oversight of key financial regulators, including the Federal Reserve. Congressman Barr is also in his second term on the Foreign Affairs Committee. Speaker McCarthy recently appointed him to serve on the House Select Committee on the strategic competition between the United States and China. Andy Barr is front and center navigating some of the most important issues facing our economy and national security, including monetary policies and China. During his time in Congress, there has been no stronger champion for Central Kentucky and the business community than our Congressman Andy Barr. It is with pleasure to work with him and his team on issues facing Lexington and our region. Please join me in welcoming our Congressman, Andy Barr.
Good afternoon. Thanks, Bob. Thank you to Kentucky American Water. Shelley, good job, and appreciate all of you all taking time out of your busy schedules to be here for a little Washington update. My good friend Tim Feld, who's with Kimi, and we were law school classmates at the University of Kentucky. After Bob mentioned my colleagues giving me these various assignments, countering the threat from China, inflation, monetary policy, the current banking situation, he said, we've got a lot of questions for you, and my question is, will Kentucky get out of the first round? And I hope so. That's the most important thing on all of our minds, I know. All of these other world crises and issues are big threats, but we want to get to the Final Four. Let me just start by saying again, thank you to Commerce Lexington for your engagement with our office. We really appreciate your feedback. We look forward to your questions and your ideas about how we can best represent this room, the people in this room, my constituents. And I want to applaud Commerce Lexington for embarking on this regional plan initiative. And for our guests from the U.S. Chamber, I really think that this is a fantastic idea to bring in the surrounding counties, Frankfort, Mount Sterling, in addition to the surrounding counties, and look at the business communities in our region to make us competitive. We've got some assets, we've got some challenges, but to think in a regional term, to help us retain the talent that comes out of the university here in Lexington and around our regional universities. We've got tremendous opportunities, and so look forward to working with that regional plan to facilitate your objectives as you go through that. What I thought I might do is just touch on a few topics: the work of the Financial Services Committee, especially in light of the banking crisis that we've witnessed over the last several days, and our oversight of the Federal Reserve's conduct of monetary policy in this historic inflation crisis, which is connected to the banking issues that we're having. And then I'll touch on the work that we're doing on the Foreign Affairs Committee and the Asia Pacific Subcommittee, and the work of the Select Committee the competition with the Chinese Communist Party, and then I'll touch on an accomplishment from the last Congress. But first, let me start with the work of the Financial Services Committee. My colleagues on the steering committee and my chairman, Patrick McHenry from North Carolina, has given me the responsibility to lead the Financial Institutions and Monetary Policy Subcommittee. That is a big topic right now. What happened at Silicon Valley Bank? What happened with Signature Bank? What's going on with our regional banks right now? This is really a pretty simple issue of poor bank management, number one. What was the proximate cause of the failure of this $220 billion bank, the largest failure we've seen since the 2008 financial crisis, second only to Washington Mutual? You had a situation, and I would say, look, there's a proximate cause and then there's some underlying causes to what we're witnessing right now. The proximate cause was really poor bank management. Let's be honest. We had a situation where you had a bank board. Only one member of that board was a banker. The CEO of that bank served on the board of the San Francisco Fed, their primary regulator. You had a bank without a chief risk officer for 9 months. You had a bank that had a very extraordinary client concentration in tech bio sector. 50% of the startup tech companies in our country were banking with this one institution. This was a bank that grew in size extraordinarily rapidly. It quadrupled in size since 2019. It doubled in size in the last year, exceeding the $200 billion threshold. The bank was over-dependent on uninsured deposits. And over the weekend, I was getting calls from Silicon Valley. I was getting calls from tech companies all over the country, from bankers all over the country, and many calls with the regulators over the course of the weekend when this crisis was materializing. And even at the end of last week, on last Friday, when the FDIC took over SVB. And I did ask the question to many of these tech companies that had parked literally hundreds of millions of dollars in uninsured accounts. Why was it that you all were so exposed, and why did you put all of your money at SVB? And really the answer was this bank, which had a niche in tech, would come alongside the substantial venture capital and provide very favorable lines of credit in exchange for these tech companies to put all of their cash in these accounts, making them extremely exposed as uninsured deposits. The banks that are represented in this room, they don't have exposure like that. There's a lot of reasons why the banks in this room, both community banks and regional banks, are distinguishable in their management of their banks and in their business models. But this bank, SVB, was unique in that it had highly concentrated deposits from one sector, and most of their deposits, 90% of their deposits, were uninsured. And then to further make matters worse, there was a horrible mismanagement of the interest rate exposure that they had in light of the precipitous rise in interest rates over the last year. This was a bank that took all of those deposits and invested them in long-dated, long-duration, hold-to-maturity securities. Now, they were safe securities. They were U.S. Treasuries and mortgage-backed securities, but there was no hedging on that interest rate exposure. And so what happened last week when they finally had to mark-to-market some of those securities, these were massive unrealized losses. Now, banks all across the country exposed to interest rate risk have unrealized losses, but there's a better asset liability matching that occurs there. And this bank didn't do that. Kind of basic mismanagement of the interest rate risk that they had. This was the #1 borrower from the San Francisco Federal Home Loan Bank. And again, as I said before, they didn't even have a chief risk officer. So all of these were red flags for the San Francisco Fed, for the California regulator, red flags that basically went unnoticed. And so when you're diagnosing the cause of this crisis, the proximate cause is obviously a failure of bank management, but it's also a failure of bank supervision. Now, there's going to be a lot of revisionism, and we do need to look at the underlying causes. And you have heard some commentary coming out of the media in today's Herald Leader, and also from Elizabeth Warren, the President of the United States, and other progressives in Washington who blame the legislation that was passed on a bipartisan basis in 2017 that recalibrated the Dodd-Frank law. This was a partial rollback of Dodd-Frank, but it wasn't a complete rollback of Dodd-Frank. And what it did was it tailored the primary objective of S-2155, this bipartisan bill that passed both the House and the Senate, was signed into law by the previous president. It was designed to tailor regulation so that the highest capital and liquidity requirements and the most rigorous stress testing would occur with the Wall Street banks, the money center banks, the so-called GSIB banks, globally systemic important banks. Then there would be a different layer for the regional banks, the PNCs, the Fifth Thirds, the key banks, Huntington banks, the U.S. banks, the truest banks. And then for the community banks, many who are represented in this room, there would be much less regulation and regulatory requirements on capital and liquidity, frankly, because those institutions do not pose a systemic risk, and also they're well capitalized and they're well managed. So this was a very positive reform. It was, not only did I vote for it, I helped write it, and I'm proud of it. And what I will say to you right now, nothing at all in that bill has anything to do with the failure of SVB Bank. Nothing, zero. In fact, a bank of the size and profile of SVB, after the reforms that we enacted on a bipartisan basis, that bank is still subject to what's called enhanced prudential standards. So enhanced scrutiny. This was not a case of lack of regulation, insufficient regulation. What it is a case of bank mismanagement and bank supervision failures. Now, what is the underlying cause of this? Well, the underlying cause of this crisis was inflation-producing policy errors that resulted in the necessity to increase interest rates at a very rapid and precipitous rate, which created a situation where poorly managed banks would get into this problem of interest rate sensitivity. So overspending in Washington, first by both parties, then by one party, and then monetary policy that injected massive amounts of easy money and liquidity into the system, even when we were in full recovery post-COVID. Keeping interest rates too low for too long, quantitative easing, even when we were in a growth cycle, that resulted in the highest level of inflation in 40 years. And so the Fed, because they called it transitory, they misjudged the inflationary effects of their easy money policies and the overspending. They had to move very, very quickly to fight inflation. And when they did, it was the right thing to do. The problem is they couldn't do it gradually. If they had started tightening monetary policy earlier to account for all of the overspending and all of the stimulus spending that was very inflationary, they probably wouldn't have been in a situation where the terminal rate of their interest rates would be as high as it needs to be. And so you got into a situation where banks who were invested in long duration securities were exposed and had big unrealized losses. But nothing in the capital requirements, either under Dodd-Frank or post-reforms enacted in 2017, none of those capital requirements would have required SVB or any similarly situated bank to hold capital against these kinds of securities, additional capital against these kinds of securities. And with respect to the liquidity requirements, we do probably need to look at the difference, the liquidity difference, the treatment and the liquidity requirements between uninsured deposits and insured deposits. This is something we should look at, because in a Twitter age, when you had such a rapid run on this bank, when social media can drive bank runs, we have traditionally both before Dodd-Frank, after Dodd-Frank, and also after our regulatory reforms in 2017, uninsured deposits and insured deposits have been treated by the bank regulators basically the same. And it's and the issue is really a matter of any bank that doesn't have that doesn't have a lot of non-depository borrowing, whether they're insured or uninsured deposits, those are treated as pretty liquid. But now in the world of Twitter, when you can have an electronically driven bank run, uninsured deposits may not be, we should consider this post-crisis here, uninsured deposits can be pretty flighty, as we saw in this one bank. So that might be one area where we might want to look at. But in general, this was not a failure of bank regulation. And in fact, if you look at what the Fed, the FDIC, and Treasury did over the weekend, it underscores the facts that the regulators had all of the existing regulatory authorities that they needed. This was a failure of bank supervision. What happened over the weekend? Well, the Treasury Department, in consultation with the Fed and with the FDIC, did two things. Number one, they set up an emergency liquidity facility at the Federal Reserve where banks that had all of these securities that were unrealized losses, they could borrow against those at par to provide them with the liquidity to prevent these bank runs, to stabilize those banks. And then the other thing that they did was they invoked what's called the systemic risk exception to the cap on FDIC insurance for these two institutions. So what that meant was all of these uninsured depositors were made whole. I think that did provide some level of market confidence and limited the bank runs in other places. The problem with that, and if you talk to any of the bankers here in the room, they will share their opinion on this. The problem with that is that although this is not a taxpayer bailout, the problem is that who is punished in this situation? It's the well-run, well-managed banks in Kentucky. And they're going to have to pay an assessment. It's good that it's not a taxpayer bailout. But unfortunately, these well-managed banks are going to pay the price in higher assessments in order to fund the excess coverage of these uninsured depositors. I think when this whole saga and this whole episode is over and we look back at what are the policy responses, one of the policy responses should be to maybe consider changing this systemic risk exemption to make sure we don't have moral hazard so that all uninsured deposits flow into mismanaged banks. We want there to be market discipline. We don't want moral hazard. We want to make sure that not just the shareholders and the bondholders and the management are punished for mismanagement, but also these tech companies who loaded all of their uninsured deposits in one mismanaged bank, that they think twice and that they look at the management of the banks, and maybe those tech companies might have put some of their deposits in Kentucky banks that know how to manage interest rate risk. I think that's a potential policy response that we should look at. We are going to now have an interesting set of oversight on what the Federal Reserve does on their interest rate path now that we have this bank crisis. The fact of the matter is they're in a really tough spot because they misjudged the non-transitory nature of this sticky inflation crisis caused by a lot of overspending. Now they've got tough policy choices because you've got a problem in the banking sector with some of the stock prices of regional banks coming down, while at the same time they still are way off of their 2% inflation target. And when I asked Chairman Powell, both in public and private, last week before the banking crisis materialized, what was the terminal rate? They indicated that it was going to be probably higher than they originally intended in order to bring inflation down. I asked him, is it going to take a recession to beat back this inflation, to overcome this inflation crisis? And they're still looking for that soft landing. I think they're starting to understand now that because they were so late in starting their tightening program, that something's going to break. And this week we saw that something indeed did break. So they've got a tough job in terms of, number one, restoring financial stability, while at the same time, inflation is still a huge problem. They're still 3 times over their inflation target of only 2%. So we will be we will obviously have our hands full in terms of our oversight in the Financial Services Committee. There's lots of other things on the agenda in the Financial Services Committee. The Supreme Court's going to decide soon about the constitutionality of the Consumer Financial Protection Bureau. There's a lot of reform to that agency that is on the agenda. And then finally, my bill that passed the House last week is heading to the president's desk. This may be President Biden's very first veto. He has threatened to veto. We expect a veto. This was a bill to depoliticize retirement accounts. So you may have heard of ESG investing, environmental, social, and governance investing. There has been a massive amount of capital flows into these trendy funds that prioritize issues like climate change, diversity, equity, and inclusion, social justice. The problem with these funds is that they do not prioritize financial performance. And what we've seen over the last 5 years is that these ESG funds have underperformed the broader market. And that stands to reason because these are higher fee, less diversified, and lower performing funds. A study by NYU and UCLA found that these funds have underperformed the broader market 250 basis points per year on average over the last 5 years. And they also carry 43% higher fees. So my bill was a bill to invalidate a Department of Labor regulation that came out of the Biden administration that would steer investors into these lower performing funds. You can, if you're an investor, you may be a socially conscious investor, you may be a values-based investor, and it's your money. You should be able to allocate your capital however you want. But the default should always, always be consistent with the fiduciary obligations under the ERISA law and under investment advisor fiduciary obligations. The default should always be to maximize investor returns. We just want to restore that principle so that you can waive that if you want as an investor and allocate your capital into ESG or anything else that's underperforming. But we want the default to always be to maximize investor returns. And we want that prioritization of investor protection and retirement security because it is estimated that the gap between the amount of money that Americans have saved for retirement versus what they will need for retirement is a whopping $3.8 trillion. So we want, through this legislation that passed both the House and the Senate, to prioritize investor returns, financial performance over politics. Real quick on the China Select Committee. This is a really big deal for our country. This is the generational challenge facing our country. The national debt is a big issue. Financial stability is a big issue. But I believe that over the next 50 years, the strategic competition between the United States and the Chinese Communist Party is going to dominate everything. The pandemic was a wake-up call. Supply chain resiliency was a wake-up call. Overdependence on China for products, goods, services. The forced transfer of technology through unfair trade practices. The theft of intellectual property, which is in the billions annually. Huge issues. Human rights, the genocide of the Uyghur population, the ripping up of an international treaty in Hong Kong. All of these things show malign and belligerent conduct by the Chinese Communist Party. They're circumventing our sanctions and financing Russia in their aggression against Ukraine. Obviously, there is cross-strait aggression with Taiwan, the democratic island that is an ally of the United States. There's a lot going on with China right now. The reason why the Speaker has told me he has asked me to serve on this multidisciplinary, multi-jurisdictional select committee is because I'm going to be focusing on the economic competition between the CCP and the United States and the West. And one of the areas of focus that I'm going to bring to this committee, and I believe this is going to be one of the most bipartisan committees in Congress. It's a very serious-minded committee. The Democrats and the Republicans, both who have been appointed to this committee, are very serious people from committees all across the Congress. They have the right temperament. They have bipartisan temperament. There are going to be other committees where there's partisanship, and there'll be, investigations into the origin of COVID and things like this. That's not what this committee is about. This committee is about preparing the United States for this competition and taking the serious policy steps to not only be on defense with the CCP, but to go on offense. And what I have shared with my colleagues on both sides of the aisle in this select committee is that as we prepare to counter the threat from the CCP, let's not try to counter China by becoming more like China. Let's embrace our advantages, our free market system, our capitalist system. Let's not allow the world to question our commitment to free market principles as we look to counter the industrial policy and the central planning of the Chinese Communist Party. And to that end, when we think about decoupling from the Chinese economy, we need to be strategic and surgical. It means that we shouldn't cut off our nose to spite our face. Where we do have positive and beneficial economic relationships with mainland China, we should do that. We should continue to export our values to the people. This committee is not about declaring war with the Chinese people. The Chinese people are our friends. They have a great culture and heritage. Our issue is not with the people of China. Our issue is with the government, the totalitarian surveillance state, genocidal government in Beijing, who victimize the people of China. And we stand on the side of the Hong Kongers and the Uyghurs and others in China who are the victims of their surveillance state totalitarianism. And I'll end with this on the China topic, and that is we want to strategically decouple. And unfortunately, right now, Wall Street is heavily invested in China. Americans are unwittingly financing the rise of the People's Liberation Army. And so we want to impose sanctions, and this is going to be my bill, to sanction those Chinese military surveillance and technology companies in these emerging growth ETFs where Americans are unwittingly financing companies that threaten our national security. We want to get all of those national security threats out of your 401k, out of these emerging growth ETFs. And finally, and I'll conclude with this positive note, you all know my personal interest in cardiology and the importance of heart valve disease for so many Americans. My wife, as you know, lost her life at only age 39 to heart valve disease. So after this tragedy happened to me and my girls, we really wanted to learn why this was happening. We found out that 25,000 Americans die of heart valve disease every single year, sudden cardiac death. It only happens to 0.2% of people with mitral valve prolapse. So Carol the odds were decidedly in her favor, but cardiology doesn't have the answers as to why this happens to some people, and mostly young women, and we don't know why, and why for most people it's benign and they can live with it for a long time. We passed on a bipartisan basis in the last Congress the CAROL Act, Cardiovascular Advances in Research and Opportunities Legacy Act. This is $28 million a year to the National Heart, Lung, Blood Institute, also $8 million a year to the Centers for Disease Control and Prevention to raise awareness and to help cardiologists differentiate between the vast majority of people with mitral valve prolapse and with heart valve disease who live long and healthy lives, and those who experience a tragic sudden cardiac death. This is going to save lives. It's going to make a difference. And you know what? I just can't thank enough all of my colleagues on both sides of the aisle to help us get this across the finish line. That's really good news. We're going to save lives with that. So thank you all very much. And Bob, you may have some questions out there. All right.
Thank you very much. We've got a couple questions. Andy Johnson's in the back. He's got a microphone himself, so we can be definitely here. There we go. All right. One question that I have is when you look at, you mentioned about international affairs, but when you look at issues like the spy balloons, TikTok, when you look at all the connections with the Ukrainian war, with Russia, Iran, North Korea, from a U.S. military standpoint, what will our country need to be doing to be able to, I mean, should we be more involved in some of these issues? But also the Chinese are taking a very strong global role in bringing together many of these countries that we've struggled with. What would you say as far as from a military standpoint, what our country needs to be doing?
Well, let me go back to the seriousness of the Select Committee. This is not the Armed Services Committee, the Foreign Affairs Committee, the Intelligence Committee, or even the Financial Services Committee. It's a cross-jurisdictional. So we're looking at it in the competition in a comprehensive way. To tell you about the nonpartisan nature and the serious nature with which both parties are taking this, when we were first put together, this group, the Speaker and the minority leader, Hakeem Jeffries, who's my classmate and who I respect very much, they came into the Speaker's, we all came together in the Speaker's boardroom, and both the leader and the Speaker talked in unison about what our goal was. And that was very encouraging when, in this polarized, divided time, to see that level of unity. And I wish the American people could have seen that common purpose and that nonpartisan tone. But hopefully you all will see that over the course of the next few months and couple years. And I think the Select Committee will continue beyond this Congress, regardless of who is in charge. The military deterrence issue is very, very important. Number one, we need to stop Americans from unwittingly financing these military companies. These are state-owned enterprises. They have a civil-military fusion. So their state is their economy and vice versa. Their military is integrated with their commercial enterprises. And so when there is theft of intellectual property, say you have a Chinese minority interest in a Silicon Valley tech company that's a gaming company, you think, well, this is benign investment from the Chinese. Actually, no, because the technology for a video game is exported into the People's Liberation Army. And so we certainly should be looking at export controls. We need to be looking at malign inbound investment. We also need to be looking at your 401k and whether or not you're actually financing some of these military companies, and stop all of that. If you don't think that we need to be investing in our national security, let me share this one anecdote. In a meeting, and this is unclassified, obviously, that I can share, a meeting that we had with the commander of NORAD after the spy balloon. So if you don't think that this was a intentional, deliberate act, let me just share with you the flight path of this spy balloon. And when the government tells you, oh, it doesn't matter, they have the same collection capabilities as a low-orbit satellite, 20 kilometers above the Earth versus 1,200 kilometers, big difference. Any intelligence community expert will tell you the closer the platform is to the target, the collection will always be enhanced and better. The spy balloons traverse over the U.S., went over Malmstrom Air Force Base in Montana. That's our nuclear triad. Minot Air Force Base, North Dakota. Warren Air Force Base, Wyoming. Offutt Air Force Base, Nebraska. That is the headquarters of Strategic Command, our nuclear command. Fort Leavenworth, Kansas. Whiteman Air Force Base, home of our B-2 bombers. Fort Leonard Wood, Missouri. Fort Campbell, Kentucky. Arnold Air Force Base, Tennessee. Camp Frank Merrill, Georgia. Shaw Air Force Base, South Carolina. Joint Base, Charleston. This flight path is alarming. This balloon should have never, ever been able to enter U.S. airspace. And the commander of NORAD, responsible for looking at this, told us that this is unclassified because he's testified in front of Congress for the last 5 years that we do not have domain awareness over the airspace of North America because our radar is so antiquated. It's from the Cold War. It is designed to intercept inbound ICBMs and Soviet-era bombers. But a slow-moving balloon is harder to detect for our antiquated radar. He has been asking, the Air Force has been asking Congress for an investment and an upgrade in our ability to detect these kinds of spy aircraft. So, yes, we can be more efficient with the way we invest in the Pentagon. But to say that we're just going to slash defense budgets at a time when we have this level of a threat to our homeland and to our national security is not the right answer. We need deterrence. When I was in Taipei on a bipartisan delegation to Taiwan, they're asking for two things, our allies in Taiwan. They're asking, number one, for accelerated military sales. The Bipartisan Defense Authorization Act this year puts another $10 billion in defensive weapons to deter Chinese aggression across the strait. We need to actually get our defense industrial base up to actually deliver. We've got $19 billion of ordered military equipment into Taiwan that has not yet been delivered. We need to ramp that up. We don't need to diminish our capabilities there. So we've got a lot of work to do to prepare. And the idea here is a strong national defense is not about going to war. It's about preventing war and deterrence.
So we're going to be bringing a delegation out, our annual DC fly-in in July. What issues do you see Congress focusing on, the House focusing on in the year ahead? And then legislative calendar, how will that flow in July and proceeding in the months ahead after that?
Well, there's obviously, I've outlined the agenda of our committees that I'm working on, but globally in the Congress, we've got a debt limit that we're going to have to deal with, and we're not going to default. But the idea here is that we want to, as we see the overspending creating a whole lot of economic dislocation in our country, we do need to, as we avoid default, obviously, we need to look seriously at a more sustainable fiscal trajectory for our country and reform the way in which we manage our finances. We cannot tolerate a situation where we act as if we're a reckless teenager with a credit card spending money we don't have. When we pay our bills and pay off our credit card, we don't just go get another credit card. We look at ways in which we can manage our finances so we don't hit the next debt limit. So raising the debt limit while we reform our spending practices it should be part of that step forward. We do have a new budget committee chairman who's going to put out a whole lot of reforms, and we want to hopefully get some bipartisan reforms to start turning this Titanic around and put our country on a more sustainable fiscal footing. The other big item that's a must-pass bill this year is the Farm Bill. We are reauthorizing a multi-year farm bill, and there's a whole lot of policy changes that we anticipate going into that bill. We hope that that bill has a tax title in it, and there's some important tax provisions for the bourbon industry and for the horse industry that we're going to try to extend and make permanent there. And then, of course, we will have the appropriations process as well. And we look forward to continuing to work with our local governments as they have priorities in the appropriations process. And as we reform the budget process and as we try to put our country on a more sustainable fiscal footing, let's make sure that your tax dollars actually get returned to our community. And that's why I like the process of Congress having some control over direct appropriations as opposed to delegating all of our appropriations to executive branch agencies and having you, my constituents, fight for grants that are disproportionately benefiting urban areas and really not helping the rural parts of our country.
And last question here. Republicans hold a slim majority in the U.S. House, 222 seats to 213. Can you share more about the dynamics within the GOP caucus and what issues may have bipartisan support?
Well, you saw the interesting, if not messy, speaker's vote. This dynamic actually is not new to me. Every time that Republicans have been in the majority, I have witnessed what some would say dysfunction. I would say rowdiness and independent-minded members. Republicans by nature are very libertarian and therefore independent-minded. I think my Democrat colleagues are better at teammates in some ways. But you owe it to your philosophy to win, in my opinion. And so if you have disunity in a thin majority, you really just turn over the power and the majority to the minority. And during that speaker's vote process, I think the majority of the majority, the 200 or so of us who were sticking together through those 15 votes, it really wasn't about a single speaker, Kevin McCarthy. It was about proving to ourselves that we could govern as a majority and not let a small minority hijack the majority to give control over to the minority. And I think that was actually a productive exercise because, number one, that small group of rowdy minority members, they did achieve some structural reforms to the institution that I think were very positive. The other thing it did was it prepared us for the debt limit. I think it helped us prepare for not going to be easy, but it helped us prepare for the debt limit. And it also enfranchised a lot of the rank and file members. And that actually will help us pass legislation in a thin majority, because now you have members of the Freedom Caucus who opposed Speaker McCarthy on the Rules Committee. So if they have amendments, those amendments can get aired in committee. They can get aired in the Rules Committee before the bill comes to the House floor. So it's very unlikely that bills will actually make it to the House floor that can't pass with the majority. So actually, this actually could produce more unity in the long run. And I have seen evidence of actually in a thinner majority, more unity and more cooperation within the majority than we've had when we've had large majorities in the past. But big things, to accomplish big things, we obviously will need bipartisanship, because the Senate is still controlled by Democrats and the White House is controlled by Democrats. And I am hopeful that in some areas, on China, on national security, on the farm bill, on the debt limit, we're going to have bipartisanship. On the appropriations process, we're going to have bipartisanship. And in the Financial Services Committee, there's a lot of attention to crypto and to digital assets. I think there is going to be some bipartisan legislation come out of our committee, come out of the Congress, and hopefully signed into law that will make some sense out of crypto, out of digital assets, and provide a regulatory framework to stop things like FTX, but also make sure that the innovation that's happening in blockchain stays in the United States and doesn't go overseas. And I think the first step on that is a bipartisan stablecoin legislation that's going to create a regulatory framework for a whole lot of innovation that's going to stay in the United States.
Congressman, I don't know if a lot of people know this, but our congressman's a champion in D.C. for bringing together Republicans and Democrats. We've even participated back here when you brought a Democrat congressman from California here, and I know you do a lot more of that out in D.C. We just need more bipartisanship. Thank you very much.